Hey, good afternoon, everyone. I think we're just about bang on 3 o'clock. Thanks for joining us for the first FFA NextGen event of 2022. Today's session will cover fund structures and market trends in Asia, particularly in Hong Kong and Singapore. My name is Lily Miao. I'm a senior associate at Moran, and I'm based in Hong Kong. Joining me today are our panelists, Terrance, Jean, and James, and I'm going to get them to give a brief introduction to themselves. Terrance, would you like to kick off?
Good afternoon. My name is Terrance Philips. I've been in fund finance for about 22 years, the last 10 years with Citibank based here in Asia. And prior to that, 12 years with Silicon Valley Bank, covering the globe.
James, Jean?
Jean, would you like to go first?
Sure. Yes. Hi, everybody. My name is Jean Wu. I'm very delighted to see such a great budget crowd. I'm based in Singapore, flying the flag for the Fund Finance Association here. So maybe a bit of a pitch. And if you do want to get involved in the association, do feel free to reach out to me. I think now with Singapore reopening, we're very, very keen to re-engage with the group, the crowd, and to get the members of the association involved and sort of liaising with each other very shortly. Thank you.
And my name's James Ford. I'm a partner in the funds and asset management team here at Allen & Overy in Hong Kong. I've been working in funds and private equity in particular for a little over 20 years now. Cover asset classes including real estate, fund of funds, private equity and private credit. And looking forward to the conversation we're about to have.
Thank you. I think I speak for all of us when I say that the past few years have been challenging, to say the least, and the current geopolitical turmoil and the ongoing COVID pandemic, which hopefully will be out of soon, will no doubt affect the path ahead. So I'd like to get the panel's views on what the current state of the fund finance market, particularly in Asia, is in your view. Perhaps we can start with Terrance.
Yeah, thank you. Listen, I think we're all in a car pulling up to an intersection and the light has just turned yellow. There's definitely not a red light yet. I think it's time for a little bit of discernment in the market. It's been full on flat out growth for about 17 years now. So if you go back to about 2005 when the market really started out here, it's just been an amazing ride. We've gone through several I think adjustments over time, right? So you go back, there was a dot-com bust, there was 9/11, you had the global financial crisis, we now have the pandemic. And through each turn, you learn something. If there's one thing I think we've learned is everything will be okay. But it's a time for us to be a bit discerning and kind of, I think, look at the fundamentals and make sure we're paying attention to them. You know, there's been a loosening, I think, of terms. There's been, it's been a buyer's market for the clients. So I think it's just time to really focus on the fundamentals. If I think of the global financial crisis, we saw some hiccups in the space, and it really, when you looked into those hiccups and even some of the recent hiccups, it comes down to loosening of a standard, missing a clause. That's where we need to be careful right now. But I think the market will continue to grow. Private capital is here to stay. It's a very well diversified asset class here in Asia now, and there's still plenty of room for growth.
That's great. James, would you like to add?
Yeah, sure. I'm coming at this from a funds perspective rather than a financing perspective. I've been surprised on the upside by how buoyant the fundraising market has stayed within closed-ended institutional funds over the last couple of years with everything we've been through. As Terrance said, maybe that's a bit on amber right now with more recent events, but certainly from our side, we're still seeing a fair bit of activity. And I think financing the funds that we raise has become a much more mainstream part of those funds operational, and it really is operations, and it really is kind of the oil that makes the market work in terms of drawdown timings and smoothing out capital calls for investors. I guess we also seem to be heading into a period where interest rates are ticking up. So the extent to which managers want to use financing and the costs of the financing may be something that reduces the scale of the drawdowns rather than the scale of the funds and the timing. But I think fund financing is a locked-in part of the alternative investment class right now.
Absolutely. Jean, would you like to comment from your perspective?
Thanks, Lily. I echo a lot of what Terrance and James have said, and maybe turning back to the financing perspective as well. I can understand why Terrance said, yellow light, discernment, because last year, 2021, was a really, really good year for funds and fund finance. But when we came into this year, I think people generally now feel that it will be a good year. But I think, two major factors. One, geopolitics. We came into this, and then, COVID gave way to the Russian-Ukraine war. I think in around our region as well, there is very discernible tightening of the monetary policy to combat inflationary pressures. So interest rates are going up. But there are actually really, maybe just as point of reference, very interesting deals in the market when I look at this. I think the market and appetite in Asian private markets very strong. We saw last month EQT strike, I think it was over 7 billion cash in stock due to buy Barings Private Equity Asia. So I think that's pretty much regarded as a very big bet on Asia's private market itself. Back down to Singapore, we knew that in the first quarter, the MES, which is our Monetary Authority of Singapore, it made a out of cycle monetary policy review and said that it was tightening its policy. So we know that all the local banks, regional banks here will be increasing interest rates. So I think from this perspective, I think from a lender's perspective, I think a lot of people will look in the financing space itself to see how the combination of all these factors will affect the near future. Thanks, Lily.
Thanks very much. Before we actually move on, I should have mentioned that if you have any questions for any of the panelists, please feel free to let us know in the Q&A box. So I think that ties in quite nicely to sort of the themes that we've been anticipating, and we've been hearing from Europe that they expect to see more ESG focused and linked products and also NAV facilities being used. What about the Asian markets, in particular in Hong Kong and Singapore? Do you see the same trends, or do you see other trends that you want to mention?
I think certainly starting to see ESG linkages to margin coming into the fund finance market. I think there's a big question about how you measure ESG against the benchmarks in this region, because we don't have quite as advanced a regulatory framework from an ESG perspective as there is in Europe in particular. On the NAV side, I've actually been surprised over the last couple of years that hasn't quite come through to the extent I would have expected. I think NAV facilities in Europe and the US over the last couple of years have really locked in, and part of that was because people thought their fundraisers would be slower and they were looking to raise investable cash in different ways. That really hasn't, at least in my experience, that hasn't happened for us in this market just yet. But I mean, these technologies are out there, and as people get more and more comfortable with them, I'm certain that we're going to see them coming through. It's just a question of when.
I agree with James. I think it's quite beyond doubt that ESG is very core, very key theme of the last few years. It's here to stay for definite. Maybe stepping away from it, I do feel that whenever I'm in leaving aside fund finance from a fund's perspective, in addition to ESG, in a different forum, I hear a lot of talk about green fintech, crypto funds from a fund's perspective. But I think I wouldn't say too much about those because I don't think they found its way into the finance, the bankable space yet. But back to zero in on the ESG focused funds, I do feel that the ecosystem itself is building, and you can see it with a lot of very good examples. So a number of the financial institutions, service providers have actually set up sustainability hubs in Singapore. And then there's a very strong institutional focus to accelerate the sustainable finance agenda. So a few examples for asset managers, we hear BNP Paribas Asset Management, Nordea, Robeco, Schroders, all setting up sustainability hubs in Singapore or announcing their intention to do so. So I think the idea is that managers would develop green finance research capabilities, launch new products. We hear also in Singapore, BlackRock, Fidelity, Fullerton, have global or Asia Pacific regional ESG heads in Singapore to drive the sustainable investing strategies, activities. Rather interestingly, so Moody's itself is building quite a comprehensive ESG capability in Singapore. So they're setting up innovation labs, technology accelerators to partner fintechs, develop ESG analytics. So I do find that on the fund finance front, so this is sort of the ecosystem that will quickly rather accelerate the development of ESG financing in the fund space. Maybe just very quick, 2 quick points which I found on ESG financing. I do see the questions being raised these days at a rather early stage. So we see a lot of lenders, borrower talking about ESG financing at a term sheet stage, which I do feel is the right time to raise questions about whether you can potentially include these requirements in your facility. As a rule of thumb, based on experience, I find that green loans or what do you find use of proceeds facilities where the use must be for a green purpose. I think those tend to be more straightforward, more because if you are an ESG focused fund, you tend to have KPIs, metrics, and reporting obligations in your organizational documents. I think the trickier one tends to be negotiating KPIs for sustainability loan. And it's what we call performance-based facilities. So it's, for me, I think those may not be as straightforward as a typical use of proceeds of a green facility, because if the fund is not focused on ESG, might not necessarily have ESG metrics or reporting obligations in its fund documents. And I think that the key reason why we look to a lot of the skill sets in banks, law firms to help guide borrowers along, because I think for these facilities, there's a certain level of complexity. The targets are set out in the credit agreement itself, as opposed to the fund documentation like the LPA. I think one very key core requirement as you look into this space is the reporting and verification obligations. So that tends to be very strenuously negotiated because I think the core aspect to remember is that credit agreement, the reporting obligation should be tied to the reports that the fund is already providing its LPs. So as a rule of thumb, I think the borrowers should not expect to provide more information about the fund or investments more than what they provide the LPs. So I feel that I think more ESG focused funds should have already in place processes and procedures in place to measure, verify, report to the LPs, including the auditors, or provide third-party opinions. So I think, just a very last point on this, as when we ask around why are people doing this, it's actually strongly shifting towards reputational. So in the beginning, people talk about margin ratchets and stuff like that. That's not really the main reason why. It's now more, if the borrower does need to meet its metrics, they'll definitely need to disclose, explain ESG failures to investors. So for an ESG focused funds, I mean, these aspects are actually very significant. Thanks, Citi.
So I guess I'm going last on this one, so there's not much to cover here. Listen, I absolutely agree with James on the NAV side. The only thing I would add is I just wonder if private capital will come in and start to solve some of these problems on the NAV side quicker than banks will be able to. On the ESG side, Yes, Gene, I agree. If you go back to October of 2021, it's public news when the announcement came out that Barings had done a deal, an ESG related facility. I think it just created a tremendous amount of interest, especially from a reputational perspective, for both the funds and their LPs. It seemed that facility came out at a time when LPs were starting to demand something from the GPs. The GPs were looking to do something, and I think that from a reputational perspective, that transaction did trigger a lot. And the only other thing I guess would be that having been in the space a long time, you start to pride yourself a little bit on being the first or second call on some of these deals. And I was very impressed on that deal that the sustainability coordinator was in that deal long before the other bank. So I think it's a great way to start a conversation. If you want to be the first conversation, have those sustainability capabilities and be there in front of the client and be relevant and have something to offer outside of the normal discussion about our product that is, listen, it's global, it's pretty standard. So I think that's something to consider, is if you want to have a relevant conversation early, firms are looking for that reputational impact, and it's a good opportunity for you as a provider to come in and have that conversation, whether you're a law firm or a bank.
Terrance, maybe just asking a quick question. Do you see this sustainability coordinator role? Does that usually just resides in the bank, or do you find that third-party providers coming into this space?
Yeah, well, listen, I have now just seen it in a few deals, and it's within the bank. There are groups out there that help with the work. I'm not sure if they would be driving a debt deal or not.
Okay, thanks.
Thank you. So ESG is here to stay. We just had a question from the audience, and whether any of the panel have any insights or updates on the fund finance market outside of Hong Kong and Singapore, perhaps more globally or in other parts of Asia. Anyone want to take this?
Take a stab at it. I'm in the U.S. now. I'm planning to visit our New York office here in the coming weeks. Listen, I think the ESG thing started in Europe, it crept its way to the U.S., and now it's coming over to Asia. I do think you're seeing some of the large institutions in the U.S. Start to recalibrate their portfolios a bit. So, kind of looking at the performance of the relationship with the private equity firm. Are we as a firm, or you as a firm, actually delivering on those promises that we make of cross-sell, other opportunities coming out of the private equity firm? Are you getting a good return on tangible common equity, or are you just deploying cheap capital? That's going to start to come into question. And I know there are several very large U.S. institutions that are really starting to look at their portfolio and say, hey, are we just throwing capital out there to work to make a little bit of revenue, or are we wisely putting this to work with our best relationships and getting a return on that capital? I think that will start to come into play. And with geopolitical issues going on, things going on in Europe, I think that spreads a little bit to where the banks are again just a little bit more discerning.
Maybe just touching a bit on the fund structures. When I look at that question, I see most of the fund financing still residing in Hong Kong and Singapore. I do obviously see some structures. I mean, James can talk about the fund structures, but I think the core reason is because you would only incorporate funds based on certain structures in certain jurisdictions. So I see master feeder fund structures, but they tend to be certain jurisdictions: Cayman, Singapore, Lux, Delaware.
Yeah.
So I think it tends to feed into these core key jurisdictions as well, and I don't see quite yet it going outside Japan, Korea, China, India yet. But happy to hear James's view on this.
I know it's a little bit apocryphal, but I think that the market is pretty global. And Terrance will correct me if I'm wrong, but I think the market is financing domestic fund structures in Japan and in China and in India. Korea's perhaps a little bit different because I think Korea has more of an offshore bias in the fund structures that are used there than some of the other jurisdictions do. But I do think it's broadly aligned with what's happening kind of in the principal fund management centers, which are themselves, we'll come on to this, but still mostly using offshore structures anyway.
Yep. And speaking of, now that we're touching on fund structures, let's take a deeper dive into the most popular Singapore and Hong Kong fund structures. So James and Jean will talk about those for their respective jurisdictions. Who would like to start?
I'll go first. So I'll talk about Singapore's fund vehicle. It's got the variable capital company, so very punchy, called VCC. It is a new corporate entity structure under which several collective investment schemes, it may be gathered under the umbrella of a single corporate entity, and yet remain ring-fenced from each other. It's not new technology. It's very similar to what we have to open-ended investment company structures in the UK, or what we call protected sale company, segregated portfolio company structures for Guernsey or Cayman Islands. It's a new corporate entity structure, and it gives funds an alternative to unit trusts, limited partnerships, limited liability partnerships, and companies. I think it's very important to remember that the VCC, it's regulated under its own legislation. I used to say it's relatively new, but now looking back, I think the Act came in 2018 and came into force 2020. That's 2 years ago. I think when I look at the stats, which is published by MES, by mid-October last year, there were over 400 VCCs. So quite an impressive growth. And in a nutshell, the VCC is an attractive vehicle for Singapore fund managers because it offers the advantages of a partnership, a couple of those factors which I'll go into shortly, but it sort of retains the core key features of a company. And you want to do that because it makes it attractive for the fund managers who wish to benefit from a lot of Singapore's extensive tax treaty network. But I guess the reason why we managed to get it up to sort of more than 400 VCCs, I think it's also in part due to a lot of the generous financial incentives which our government has dished up. The MES introduced the grant scheme, so to encourage people to adopt the structure or to convert into VCC. What it does is it covers 70% of the eligible expenses, caps at Singapore 150K per VCC, and it's for work done in Singapore in relation to the incorporation, redomiciliation of the VCC. So you cover legal fees, tax advisor fees, regulatory advisory fees, setups, and consulting fees. I think it's initially very attractive to family offices because of the grant, but coming into late 2020, 2021, I think it's expanded beyond just family offices. So we've seen the adoption being taken up or extended to much larger size asset manager, global players taking up the VCC. So we've seen AIA, Fullerton Fund, sort of, redivert or co-locate their investment management activities into Singapore. The main key features of the VCC, one of the benefits people keep touting about is the flexibility. So the VCC can be used for both open-ended and closed-ended funds. One key aspect of it is, even though it's a company, it helps and it's very attractive for funds because it can also freely redeem shares and pay dividends. The capital of the VCC will always be equal to its net asset. So that means there's flexibility for the distribution and return of capital. I mean, that's opposed to companies that are subject to restrictive capital maintenance requirements. It has sub-fund structures. So I think that's the cell concept. You have in Guernsey, Guernsey and Cayman Islands. So you can set up the VCC as a standalone vehicle or a umbrella entity comprising a number of sub-funds. So these sub-funds have separate asset and liabilities, and one can go insolvent without affecting the solvency of the other. There is a strong economic substance requirement for the VCC. I think that's quite specific, and Singapore wants that because I think the whole philosophy around doing this is we want to drive the ecosystem, not just any one part of an offshore vehicle. We want the law firms, the auditors, the banks, everyone to come into Singapore. So the VCC has director requirements. It must have at least one Singapore resident director, or at least one director who is either a director or otherwise a qualified representative in Singapore. So it's also it's also not required to, I guess it's a flexibility, not required the whole annual general meetings. And general meetings will only be required when requested by 10% of its shareholders. I think even though it's a company, the core requirement of it that is registered at our company's house, but the shareholder register and the financial statements are not publicly available. Last but not least, tax. And I think I could go into quite a bit about tax, but I think BCC is treated as a company for tax purposes, and it does, as I mentioned before, access Singapore's treaty network. It also qualifies for a number of existing income and tax fund exemptions currently available to other fund vehicles. So I think, in a nutshell, I think the vehicle is certainly not intended to be funded remotely or on an offshore basis. There's a lot of economic substance to it, and with geopolitics aplenty here and a huge influx of capital inflows, I think a lot of people partly feel that I think this vehicle in Singapore will definitely grow from strength to strength.
Just taking a step back for a moment, I think it's only fair to say that the most common vehicles, at least in the closed-ended asset classes and the institutional funds market, are still offshore. And within that offshore segment, predominantly Cayman, we see the odd Channel Islands and the odd Luxembourg parallel structures creeping in to deal with European regulatory issues for European investors. I think there is, to the extent that there's an onshoring trend, I think it's still fairly early on in that trend, both in Singapore and in Hong Kong. Hong Kong has a couple of relatively recent fund vehicles which have been brought out in that last 4 or 5 years ago. There's the OFC, which had a bit of a slow start, to the extent that the Hong Kong government put incentives in place around use of the OFC, which are broadly similar to what the Singapore government has for VCCs. And then more recently, we had the Limited Partnership Fund Ordinance, which came into force August 2020. Similarly, we've actually had a bit over 400 LPFs registered, and certainly starting to see them taken up by high quality international managers. I think that trend will continue. It's not going to swamp offshore out the market probably in my professional lifetime, but it is building. The Hong Kong LPF is very much like any other limited partnership, except that there's a requirement that it be managed by a Hong Kong-based investment manager, which is sort of similar to the substance requirements for the VCC that Jean was talking about in Singapore. It's very flexible, very easy to set up. No incentives around using them from the government yet, because I think they perceive the takeout to have been sufficiently strong that incentives weren't needed. It has a lot of support from the HKMA, both in its capacity as kind of market development, but also in its capacity as an investor. It's strongly encouraging a number of its managers to use LPFs in the structures where that's appropriate. Very flexible, and really looks and feels very much like an offshore partnership. You can do pretty much anything with an LPF that you could do with an offshore partnership.
Thank you, James and Jean. So if I were a lender lending into these structures, is there anything that I should particularly be aware of that might be different, or anything when I'm doing due diligence?
I think if you're looking at an LPF, you just want to be aware of the registration requirements and make sure that you've ticked all the boxes from a due diligence perspective, that it has an investment manager. If the investment manager needs to be licensed, that it's licensed, that it's made the right filings in connection with its establishment. There's a little bit of a catch in that an LPF must admit external investors within a 2-year period after formation. So if you're looking one that's kind of been left on the shelf for a while, you might want to be a bit careful about that. But broadly speaking, from a commercial perspective, the diligence you would do with an LPF is very, very similar to that you do for any other fund. If you're looking at sort of VCCs and OFCs, which can both adopt umbrella structures with subcompartments, that's where it gets a bit more intricate, and you really need to make sure that you know which compartments you're lending to and which assets you're looking to, if you're looking to asset-based security, and which investors you're looking to if you're looking at investor-based security, because you do have this segregation between portfolios, and the fact that the VCC or the OFC as a whole has an NAV of X doesn't necessarily mean that without cross guarantees between compartments, for example, you would necessarily have access to all of those assets as a lender.
I think from a Singapore perspective, I actually echo a lot of what James said. I think it's always key to remember the basics when due diligencing a fund for financing. I think the same core principles should hold true across the various vehicles. I think when you do that, it's first you must understand, as when you're diligencing, to understand the legal personality of the VCC, and that's going through the VCC Act itself. There are certain sort of key core administrative differences. One quirk is a VCC, for example, must always have VCC as part of the end of its name. And then when you sort of in every agreement, it's actually specified under the Act that you must set up the name of that subfund, registration number, and that the fact that the funds or the assets are segregated. When you look at the fund documentation, which in the case for the VCC would be the Constitution, not the LPA, you must look for key core bankability provisions in the same way as you look for them in your LPA as well. So a couple of those is always look, to check that, whether that it has the capacity and authority to enter into this debt financing, and then check it, the Constitution, to make sure that the proposed subline or fund finance financing does not conflict with the terms of your Constitution or the fund's Constitution. One key aspect which you should always check as well is always look to see whether the borrowing and indebtedness is expressly permitted. The Constitution will always specifically permit the fund to incur indebtedness. Any specific provisions on the limitations on purpose, amount, term, indebtedness should be actually duly noted. It's also quite interesting to note, actually under the VCC Act, the assets of a sub-fund of a umbrella fund, umbrella VCC, must not be used to discharge any liabilities of the VCC or any sub-fund of the VCC. Then going past the initial questions like that, procedurally, look at the documentation and look at the mechanics to call capital itself, because that's quite important from a financing perspective. To look at the provisions of how the capital are called, notice provisions, time frame for payment, purpose of which the manager is permitted to issue the notices, That needs to be understood. I think it's also key to look at that and to see whether to make sure, confirm and ascertain that one of the purposes for which the notices to call capital for can be used to repay principal debt, interest accrued thereon, and costs related to it. These provisions in a well-drafted constitution or LPA should be clean, clear, quite precise. I think also because of the VCC is also a company vehicle, I think quite uniquely when we looked at it, please make sure that you does apply the requirement to issue shared certificates, which you can. Procedurally, it is not ideal, and it's a bit of an impediment for enforcement. Also check that under the Constitution, that the funds is permitted to grant security over its own, obviously, subfund assets. Then when you look through it, I think the further points which make a structure bankable should also similarly apply. Look and ask, what's the term of the fund? In what circumstances can this be terminated, dissolved prior to the term? Would that affect your facility? That the commitment period, I think very importantly, of call provisions, or just make sure that there are no restrictions on lender or third-party beneficiaries on relying on these or on the Constitution itself. So I think, I just sort of went through, very quickly, broad base of bankability checks which you should do for a fund. I think those are generally applicable for VCC as well.
And just, I think both James and Jean have touched on this, where you have an umbrella VCC with subfunds. We've got a question asking, are there any challenges in taking capital call security over these subfunds? Or would they be similar to your usual fund structures?
It's not a great deal different in some ways, but you need to remember that each subfund is effectively a separate fund. And so you need to approach it, if you're lending to more than one subfund at a time, you do need to approach it as multiple borrowers rather than as a single borrower. And that's really just the thought process you have to go through, even though it's all within the same kind of legal entity framework.
I agree with James. I think the reason why it's called an umbrella fund is actually it benefits operationally the managers across the board. They can actually consolidate financial statements and stuff like that, and it's sort of I think from that perspective easier to manage. But when you lend, like what James mentioned, that the whole idea is a subfund is a fund. I think it's ring fenced. Sorry, I don't think so. It is ring fenced. I think the provisions, the core capital, and all that's how you should look at it. It's a standalone fund, and it should be clear, precise, and quite specific to that sub fund how you call capital.
Thank you. So we've got a question for Terrance, which kind of ties into what we've already discussed. Have you seen a significant enough shift or movement from the traditional fund structures to using the LPF for the VCC?
No, I haven't. But that could be a symptom of being with a very large organization. But what I think about when I hear this is I kind of go back to the early days in China, where you went to RMB fund, then to a JV fund, and then you're going to file for your Q fee. And I just kind of going over that history. Any kind of scheme that's born out of prescriptive nature, it's set up by a jurisdiction to solve one or two problems or to create some kind of balance. They typically don't push away the traditional structure. So, to James's point, you still have the core Cayman fund structures. You're still seeing the Lux structure for European LPs, and I don't think that's going anywhere, right? We see a lot of different things come up along the way. They serve a very specific purpose. They're very good structures, but they're used for specific needs. So I just kind of see these structures right now probably falling into that basket. But again, I may not be seeing them from our perspective, just being a large institution that's very set in standard structures.
No, I actually agree. Sorry, I'll just add, I do agree with Terrance. We've seen a lot of the early adoptions of some family offices. And then now, because it's Singapore, used to, a lot of the Singapore governing organizations choosing it. Then because it's such a vehicle where people say, let's just try to make sure that we grow the ecosystem, then people look at it as, is it good to use it as a securitization vehicle, SPV vehicle, that sort of considerations in order to make it slightly more popular. So I think that's why I think we look at it in Singapore, we try to make sure that it's popular, but then when you look at it from a fund finance perspective, then you see actually the Cayman ones, the Lux ones are the ones that actually still traditionally being trusted by a lot of the global managers.
Yeah, I think, again, coming at this from a fund structuring perspective, there's an awful lot of inertia in the market. And one of the biggest drivers of the inertia is investor familiarity. People are really resistant to changing what they put in front of their investors unless there's a really good reason to do it. And so far, we haven't really had the push factor driving the funds away from Cayman or Luxembourg that would really kind of kickstart the acceleration of these new vehicles. Cayman's had some twists to some of the requirements there, but it's not really a huge push factor, which would, as I say, kind of really accelerate the onshoring process. There just isn't enough irritation with what's there already.
Yeah, I agreed with all of that, and I there's also a question from the audience. Do you see any demand for European offshore structures? I think we mentioned Luxembourg, Ireland.
And I think I know I can see the question on screen. I think a number of the bigger funds will have Luxembourg vehicles within their structures, primarily because they're marketing globally and they want a vehicle that they can do what we call passporting under the AIFMD in Europe to access European investors. Ireland has what looks to be, in theory, a very attractive limited partnership regime now. I think it doesn't have a lot of track record in that space. And I think the big challenge is going to be, how does Ireland attract the business that's currently going to Luxembourg? My suspicion is that the early adopters of the Irish vehicles won't come from our regions, but will come from the US. And it will be because the US managers want a European vehicle that is domiciled in an English-speaking common law jurisdiction, but still able to access the EU. And possibly, and I hope I don't offend anyone by saying this, possibly one that's in a jurisdiction that has a slightly more aggressive work ethics than Luxembourg.
Thank you. I think there's also a question about if the panel could share their observations on managers' appetites, sort of comparatively between Australia, Hong Kong, and Singapore. Do you see any preference for one or the other, or is it very deal specific?
I think it's very manager specific. Australian managers are in Australia. People who aren't in Australia don't use Australian structures.
Yep, that makes sense.
Some Australians have offshore elements within their structures, but a lot more have pure domestic Australian structures.
Yeah, that makes sense. So if the panel had to pick a particular fund finance transaction that you thought was significant or interesting over the past 12 months, what would that be and why?
I think I jumped the gun on this one and shared early. Again, it's a public transaction. It was the Barings transaction, but this is really the NextGen is the reason we're here and speaking today. So just kind of deviating from our kind of answers here. If you think about going into building your career, taking your organization to the next level, you want to be the first call, right? You want that door to swing in. You want the clients to come to you for your expertise. And again, this transaction, we weren't the lead bank on this transaction, but I felt we were very close, to that transaction. And when I saw how well BNP got in early, and really dove into the nuts and bolts, being the sustainability coordinator, you really see value there. You really drove value, and we had the same capabilities. We've brought on an individual to our team. We have a sustainability coordinator. She's our ESG coordinator. She did the very first transaction in this space, but we weren't out marketing it aggressively. And so if you're thinking again towards how do I push my firm to the forefront, that was a unique lesson. And that's what I took away from that transaction was, never get too complacent. You can never be too compliant, but never get too complacent. And these things happen from time to time. And that's what I really saw as special about that transaction. And then once it hit the news media in October, a lot of our clients, we were having these discussions. And, listen, we learned from it. We got our ESG coordinator, our ESG head out on the phone. But that was very unique to see that happen. So again, just from the NextGen component, that's where I think if you're young in this space, you want to be working and developing your relationships to make that door swing in. And this was a very good example of an organization having a talent, having an expertise, and making the door swing in.
Absolutely. Jean, James, do you have anything else to add or share?
I'm a funds lawyer rather than a finance lawyer, so I don't actually see that many of the financing transactions. But certainly the Barings deal was, I think, the one that caught everyone's eye in the market over the last 12 months.
Yeah, I agree. Maybe just to add on that as well. I think when we go to see clients itself, we used to say, see like what's your skill sets, how good are you in diligencing, picking up familiarity with LPAs, what's specific in this side letter for the LPs, do you know? So I think that's why you try to push your expertise. But these days, like what Terrance says, the idea of the sustainability coordinator getting very, very involved in the term sheet stage, guiding borrower, guiding the rest of the banks into it, I think that really pretty much sets you apart. And if you acquire that core skill sets itself, I think that's the part that seems to be really growing or accelerating in this space itself. So I think that no wonder that sort of deals actually, caught everyone's eye.
Thank you. I think the next question is sort of related to generally the fund finance market in Asia, for Jean and James. What would be the top 2 or 3 issues from a legal and regulatory perspective that a lender or market participants should take note of if you're going to be participating in the fund finance markets?
I think I can take that first, and I think the issues relate to the ecosystem, like the finance system itself. So I think that the 2 things I picked up, which will be a major trend, are very, very strong financial regulatory changes that will affect banks, asset managers, insurer. So what you see coming through in Asia, into especially Singapore, is stronger regulatory oversight within the financial market. That's not just funds finance, but I think that because that's quite significant, it's the finance market. So more specifically within sanctions, AML, very stronger enforcement rights from banks relating to these areas. Many of you would know that in Singapore, we took very early proactive steps in the Ukraine-Russia conflict to impose export control measures in Russia. We also, when many people feel, quite quickly ahead of ourselves, imposed financial measures targeted at designated Russian banks, entities, and activities in Russia. I think it's actually a reflection of how geopolitics will affect us very quickly in the financial markets. Geopolitics, country risk, very significant focus. So what I do see coming and impacting on deals that for deals from other jurisdictions. So when you look at the US funds, when they come into Southeast Asia, I think that for sure you see a lot of questions raised around enforcement regimes, timing, what their legal impediments. So I think there's a lot of scrutiny in the risks in this area. I think for FinReg, financial regulations will become very tight. I think closer to home on the fund side, I think we do have, again, just banging on the VCC. MAS is pretty bullish about it. So you will hear a lot being talked in the market. Version 2 of it, version 3, I think it's going to go all out. I know it's not very popular yet, but I think don't tell that to the Singapore government. So they are actually trying to improve it. And I think the next target is to target redomiciliation. So I think they are keen, or MS very keen to expand the reach of the scheme to attract more asset managers to launch new funds and establish in Singapore itself.
Yeah, and I think generally and globally, there's increased scrutiny of fund managers. I think key areas of focus that could impact kind of the solidity of the investor covenant to pay. The one that's really to watch is tightening up on pre-investment disclosure requirements and making sure that marketing documents have the content that they need, because failures in those areas are often kind of linked to a right to rescind investments. So that's really one to watch out for. And there's also ESG disclosure and ESG reporting stuff coming through for managers at differing speeds in different jurisdictions. I'd also always have half an eye on what the SEC is doing, because that tends to have significant extraterritorial impact. And there are various proposals at this stage as regards fund managers that are coming out of the SEC that would mean pretty significant operational change, both in terms of standard of care and also on the ESG side.
Absolutely. Lots of things to watch out for. I think we can finish off the session by asking the panelists to kind of give your views on what you think the future holds for fund finance in Asia.
And look, I can take that first. I still think we are maybe 40–50% of the way to a mature market in this region. So I think the penetration is only going to increase in the closed-ended sectors. It is, as I said earlier, it's the oil that makes the whole system work. I think we have some products, but not yet all, as part of the armory in our markets just yet. Part of the reason I think NAV facilities haven't quite got as far here as they have in the other markets is that we have a lot more investors here with growth stage investments and minority interests in portfolio companies, and that's not quite as attractive a security package as a control stake in a company. So that's one of the things that I think we have to figure out. And I think it popped up in the questions earlier is why do we think that private lenders might be able to get there faster than banks? I think it's because they will be potentially better able to value minority interests in portfolio companies that are held by some of these growth capital funds, and perhaps willing to take a little bit more risk in return for a bit higher return in lending against structures that don't make control investments.
I think from a Singapore perspective, what the future holds is, I think we will progress beyond what we have now. So you see a lot of lending to institutions and subline facilities. So you're right, we're like James said, 40% there, like there's a lot more to develop in terms of your technology in this space. Margins pricing is pretty compressed. So even like some of the deals you see, see 80, 90 bips. And I think in a fast rising interest rates environment, I think that's not going to be enough. I think people or other banks will look to very quickly NAV hybrid GP lines to differentiate, get to better yield. I think that's quite a sort of a standard sort of reply and view of the market in Singapore itself. As to what the future holds, I hope that we get back to more face-to-face social events and back to our live symposium in Hong Kong or Singapore. Those are great events. So I hope that's what the future holds, or rather the near future holds for us.
Yeah, I for one certainly would like. I think Terrance, you're on mute.
Yeah, at this point, I don't think there's too much more to add. Just in the immediate next 12 to 24 months, keep an eye on the geopolitics, how that impacts regional banks versus global banks, U.S. banks, European banks. I think that will be very interesting. And that dance floor will start to shift around. Competitive advantage, will go different ways. Cost of funds will be a very interesting issue that we'll see coming up in the next 12 months. But in the long run, I absolutely agree with James. We're 40% of the way there, and lots to see, lots to still see. I think the growth of private capital in Southeast Asia will be very interesting. Personally, I think that turns out something like an Israeli story, where a lot of global players, a lot of big regional players coming in to serve that space and fill in those holes. Great stuff ahead of us.
Just a follow-up question for me. Do you think we will see more use of hybrid facilities or preferred equity, which I think has been talked about a lot as well?
Yeah, listen,
Terrance, you go first.
Yeah, to the extent that the banks can get comfortable, right? The one thing that is slowing us down is the banks just aren't there yet in Asia.
Yeah, I couldn't agree more. On the pref equity side, again, I think we're probably at the beginning of the curve on pref equity in Asia. We haven't seen a lot of it yet. I think you could probably count the number of pref equity deals that have been done in our region on fingers of one hand. There's fund restructuring and continuation funds is a whole nother kind of topic of conversation, which perhaps pref equity fits more into that discussion than it does into financing. But there is a lot going on, but pref equity isn't a big part of it just yet.
Great, thank you very much. I think we are just about nearing our time. If there's any burning questions that weren't answered today, feel free to reach out to the panelists. The session is also recorded, so if you'd like to watch it back, or if you didn't get a chance to dial in, the link will be made available. I'd like to thank everyone for joining us today, and also thank you again to our panelists.